Hi, everyone. My name is DJ Wright, Director of Investments at Financial Freedom Wealth Management Group. And today we have our market update for you, 2025 Mid-Year Outlook, Tariffs, Inflation, and Economic Stability. Thanks for listening in. As I mentioned, I'm DJ, Director of Investments and Financial Advisor. I've been with Financial Freedom for a little over 10 years now. Very grateful to have found financial freedom. I love what I do, helping clients, and specifically focusing on the investment side. A little bit about us. We were founded in 2001. We're a comprehensive wealth management and financial planning firm. Our pursuit is to be the nation's most caring financial advisory team, guiding you, your loved ones, and your legacy toward lasting financial independence and a life of fulfillment. We serve pre and post retirees who want strategic planning to make the most of their money and save on taxes, people seeking to grow and protect their wealth, as well as business owners needing financial services. Our commitment is always to care deeply about you and your financial life. Our pursuit is to be the nation's most caring financial advisory team, guiding you, your loved ones, and your legacy toward lasting financial independence and a life of fulfillment. We serve pre and post retirees who want strategic planning to make the most of their money and save on taxes. We also help people seeking to grow and protect their wealth, as well as business owners needing financial services. And our commitment is always to care deeply about you and your financial life. Here is a recent photo of our team members from our July team day. So we currently have 23 people on our team. That's 6 advisors and 17 support staff, and we're always growing. If you have questions during the webinar, go ahead and text that number that you see here. It's 458-777-4458, and we will answer them at the end of the webinar. Okay, well, let's get into it. So our 2025 mid-year outlook. First, we'll look backwards and talk a little bit about what we saw the first half of the year, and then we can look forwards and discuss what we could see here the rest of the year. So trade policy was the focus the first half of the year. Not surprisingly, that was the main driver of markets moving up and down. It was a very fast-moving, uncertain, and volatile first half. We don't see years like this very often, where we have quite the amount of volatility that we did see. So we go back to April 2nd. That was the announcement of the tariffs, and it was a lot higher than most people expected. And that's why we saw a pretty big decline coming off of that. So over the course of the next week, the S&P 500 dropped 12%. And the total decline from the recent February highs was just about 20%. So that's right there on the edge of bear market territory, not something that we see that often in the market. So it was a pretty steep and intense decline. 1 week later, on April 9th, we learned that the tariffs were being paused and pushed out a bit. And we saw the markets rally in an amazing fashion. So on the 9th, the S&P 500 increased 9.5% in one single day. It was actually the 8th best percent gain for the S&P 500. The NASDAQ, which is more of a tech index, actually increased more than that. So a huge upswing. And since then, so since the April lows, we've seen the S&P 500 rally about 25%, and we are basically at all-time highs. So the end of July was the most recent all-time high for the stock market. Pretty incredible. So we went through almost a bear market and then a full recovery and hitting new all-time highs all in a span of a few months. So it can be hard to go through. It's not always easy. I think when we come out of it where we are now and we can look back, it's important to, take some reminders for the next time because volatility does happen and it will continue to happen. And so when you're in it, it's really hard to take away lessons and it's hard to stick to your strategy and stay disciplined. But now that we're on the other side and we can actually see all the data and what actually transpired, it's a good reminder that markets can be very emotional in the short term. We can see big swings, but that's usually not the time to make changes. That's generally the time to stay disciplined, to stick with your strategy, and know that over time, history has shown us that markets do increase over the long haul. And you never know what's going to happen. It's really hard to predict this. Think about that almost 10% gain in one day. If you had shifted things and got out of it, let's say the 8th, you could have missed that 10% up day. So when we're having this volatility, things can be swinging in both directions really quickly. And that's usually where you want to just stay put and ride it out. And that's what we help our clients do. International stocks lead the way. So this was great to see. Again, I've been here for 10 years, and basically that whole time has been US stocks have dominated international. It's just the way it's been, and we've seen this in various times in history where US has done really, really well. At some point, the pendulum has always swung back to the other side. And finally, this year, while the US went through what it had to go through, international was that rock that we could lean on, and it did very, very well. So for the year, international stocks are up in that 15 to 20% range, whereas the S&P is more in that 7 to 8%, and the Dow Jones is up around 4%. So international has done really great. We believe that in a diversified portfolio, it's really important to have international stocks. And before this year, you may wonder, why do I have this? Why do I have this? Why not be all US? Because of years like this. Sometimes things change, and it can be a really big help to have a diversified portfolio to own companies all over the world. We did start to see signs of a slowing economy. Now, I'll say slowing, but not necessarily negative, because the economy was very resilient in the first half. But there have been some signs that it's slowing down, which is really expected as the Fed has raised interest rates and kept them higher. They were intentionally trying to slow things down a bit to keep inflation down. But we did start to see that. So in the first quarter, we actually got a negative GDP number. It's a little skewed because that was due to companies importing a lot before the tariffs took place. And so you actually have to subtract all the imports from that GDP number to get the real GDP as imports as money is leaving the US. So you have to subtract those. And that's why we got that negative number. But consumer spending started to decrease a little bit. So it still rose about 0.5% in the first quarter, where it was more around 4% in the end of 2024. So things were starting to slow down a bit. In Q2, we saw GDP jump back up. So it was at 3%, which was a great number, and consumer spending increased about 1.4%. So really a strong economy, but starting to slow a little bit. And we've seen even the last few weeks some new numbers that shows it's probably continuing to slow, which we'll talk about here in a little bit. Okay, so let's talk about the second half, which we're already well underway, whole month in. What could we see? Where do we go from here? So still a lot of uncertainty. That's for sure. I think things have cleared up quite a bit. We definitely have a better grasp of what some of these tariffs and trade deals are going to look like, but there's still a lot of uncertainty. And things can also change quickly, as we've seen. Even recently, we had some new announcements of tariffs. So the uncertainty is still there, and that will continue into the rest of the year. Trade policy and tariffs will still be the focus. We've got a lot of good trade deals. We need some more. So hopefully that continues. Of course, tariffs, that can change in any given day. So that'll be something that will still be a driver of performance for the markets into the second half of the year. The Fed. So this is a big one. The Fed has been on pause all year. So as a refresher, the Fed is there to help us keep the economy moving along at the right pace. So not too hot because then you get inflation, but not too cold because then we're not growing. So they want to find that sweet spot. So they have what's called a dual mandate, where they are focused on maximum employment. So really strong economy, good jobs. They're focused there, but also price stability. So they have to weigh both of those. And generally, if you get really strong employment and a strong economy, you get some inflation with that. So they have to be careful and balance those two out. And so they have paused all year. They have not cut any rates. Part of that is as they wait to see some of the effects of the tariffs. So it's very likely that we will see them cut rates in September. So I believe it's around 80% chance that they will start to cut in September. Some of the recent job numbers that we got that were a little poor has likely given them the go ahead to cut rates, which is why we saw the chance of a cut jump up to around 80%. So what the Fed does in September, but also the rest of the year, will have a big effect on how the markets, perform. I think they're ready. The markets are hoping for a cut. They're likely expecting that and really ready for it. So we'll watch that. September will be a big thing to keep an eye on. Inflation. Now, this is directly tied to the Fed and is going to be a big driver of what the Fed ends up doing. But does inflation go back up? We haven't really seen that so far. So inflation sitting around 2.7% right now. So under 3%. And the tariffs, there was concern that that could increase prices. It hasn't really much. So that's a positive, but we'll continue to watch that. Some of these policies can be lagged as well. So sometimes it takes a while to actually weed through and affect the economy. So that's something that we'll be keeping an eye on. The Fed will be keeping an eye on. If that can stay low and stay below 3%, that will allow them to cut rates, and that will be a positive thing. So I think for the rest of the year, there's likely going to be some more volatility, so be prepared for that. I think there's a really good chance that we continue to move higher, and I'll show you some charts here in a minute based on history, but there could be more gains for the stock market. But again, it's going to be volatile. There's going to be ups and downs, so just be prepared for that. So some risks to watch. Yes, there's always risks. Escalating tariffs and trade wars. As we know, that could ramp back up at any time, and that's something that we'll have to wait to see. Hopefully that doesn't happen. Hopefully we continue to get more deals with other countries, and that'll be a big positive. But of course, these things can change, and so we'll have to wait and see how that pans out. Inflation reigniting. I mean, we just talked about that, so that's still a possibility if inflation did start spiking again. That puts the Fed in a tough spot. And of course, inflation, I mean, nobody likes it. It makes things really tough for the consumer. Things are expensive. It costs a lot to buy groceries, to really buy anything. And so inflation we don't like it, and we do not want that going back up to what we saw a few years ago. The labor market cooling. So this has started to happen. And even in the last week, we got new job numbers. And in July, we added 73,000 jobs, which was a lot lower than what we were expecting or hoping for. But also the other side to that is we revised the previous 2 months numbers. And so the average uh, job growth over the last 3 months has been 35,000 jobs, which is not very much. It's pretty low. Earlier this year and last year, we were adding in that 130 to 140,000 jobs a month. So really growing. So these numbers are a lot lower. And that's something that we'll have to keep an eye on if that continues to cool. Now, remember, this is not negative. We're still adding jobs. It's just at a much lower rate than previously. And so hopefully that doesn't continue and hit a negative number, but that's something that we'll be watching. The US debt level. So we're 36 trillion in debt. This is something that, I mean, we all know about. It's nothing new. And I think it pops up into the media every once in a while. It starts, we hear more and more about it. So it's going to increase with some of the new legislation. It is going to increase a little bit. And I think it's something that we'll have to deal with at some point. This is not like, okay, it's we've hit the line and there's a crisis right now. I don't believe that's the case. I think it can go a lot further, but it's something that we do need to get in order. And hopefully Congress will do that at some point because there's real effects of that debt increasing. That's interest that future generations have to pay to service that debt. And that's less money that they can spend on their own programs. It will likely increase interest rates as that debt continues to grow. It can be inflationary. There's something called the crowding out effect, where it takes money away from the private sector as more dollars are being loaned to the US government, and so less money available for the private sector. So there's real effects as that gets bigger and bigger. So that's something that we will always be watching, and hopefully we can get that, leveled or not increasing like it has been. And then geopolitical instability, that's always on the table. There's a lot of things going on around the world. There's wars going on. And so, anytime um, anything, something could progress, that can have short-term effects on markets. And so that is a risk to watch as well. So what's going well? There is a lot going well. I know we tend to focus on some of the negatives. It's just human nature. We all do it. There's a reason we're at all-time highs in the market. And that's because a lot of things have been going well so far. Trade deals and lower overall tariff rates. So as we mentioned, we've been getting lots of trade deals and we've heard about these. They're in the news. That's great. We'll likely continue to get more and more of those. Lower overall tariff rates. So it's expected that the effective overall rate may be right around that 18%. This is a lot lower than what it was looking like back in April, where it was, I believe, in that 25 to 30%. So the overall rate has come down quite a bit, and that's a real positive, and markets are liking that. Tariffs are one of those things where there's a lot of positives, right? There's a reason we're doing it. It's a sweet spot, right? So markets didn't like how high they were. They've come down a little bit, and markets are okay with that and feeling fairly good about where they're at. Resilient economy. We really have had a very resilient economy through all this. It's been humming along very nicely. Strong corporate earnings. Companies are making money. Tariffs, no tariffs, they're finding ways to make money. And the numbers are showing that. So we actually just went through our second quarter earnings for the S&P 500, and they've been really great. It's been a 10% growth for earnings year over year, and 82% of companies are beating their expectations. So the numbers are really good as far as companies and their earnings go. The Mag 7, Magnificent Seven, have been a big part of that, and they're providing great numbers as well. So that's really the strongest driver of market performance over time. In the short term, markets can be very emotional. They're going to react to different policies, headlines, what's going on at that time. But long term, it's about, are companies making money? Are they driving us forward? Are we creating new products? And so far, corporate earnings have been really good. Low unemployment, we're sitting at 4.1%. It's pretty good. Historically, that's about where you want to be. It ticked up a little bit recently, but unemployment rates in a good spot. Wage growth and consumer spending. In July, wages grew by 3.7%. So we are still moving in the right direction. That is more than inflation, so that's always good. And the consumer's been spending money. As you can see through corporate earnings, that's because people are spending money. So that helps drive things forward. And then inflation is below 3%. So that's always a positive. It's not like we've gone negative. So obviously we're in a new environment where things cost more, but the rate has come down quite a bit. So we like that, the Fed's goal is 2%. We're still a little higher, but that's come down quite a bit and it has not shot back up. So there's a lot of positives out there. Let's look at the stock market outlook going forward. Okay, so a lot of numbers on here. I'll walk you through it. This shows, going back to 1950, various what we call corrections. And a correction in the market is when we decline anywhere from 10 to 20%. So this shows the various corrections that we've seen. And you can see the high, the date that we hit our high point, and then the date that we hit the low point. And so you can see the most recent one here. April 8th was the low point earlier this year. And then you have the percent decline. So that is the decline. You can see here it's all between 10 and 20%. And then we go through the recovery. And usually these are what are called V-shaped recoveries. These are quick downturns, and then we recover quite nicely, generally pretty quickly. And so you have the date that we finally recovered. For this most recent one that we're going through, there's a question mark there, but we actually do know it was June 27th was when we fully recovered from the decline. So this chart we had created just before that, but end of June, we did recover. And then you can see the 6-month returns and the 12-month returns from that recovery date. So now we're at all-time highs. Where do we go from there? Just because we're at all-time highs doesn't mean we can only go down. Generally, we can continue higher. And for 6 months out, the average gain has been 9.6% with a median gain of 11.4%. And we've been positive 91% of the time. So pretty impressive numbers there. And when you look a year out from that recovery date, the average gain has been 16.2%, median gain of 14.6%, and also positive 91% of the time. So this is just, it's a reminder, and history reminds us that yes, we hit all-time highs, doesn't mean we're going to go down. A lot of time gains will stack on top of each other. And when you look at any chart in the market, you see that we are consistently hitting new all-time highs. Yes, we have volatility, we experience downturns, we generally recover from them and then move on higher. So we'll see what we have in store from this one. But since June, we've gone up even higher. So we're on the right path so far. This is a little bit about the earnings. So I mentioned that we've had great earnings and big tech, specifically the Mag 7, has been very good. That's been a primary driver for the S&P 500 for a while now. You can see the blue bar shows earnings growth for the Mag 7. And the orange is the S&P 500 excluding them, so all the rest of the companies. So you can see it's pretty overwhelming how much those companies are really driving a lot of the earnings. Now, I think when you look at our projections for the rest of the year, it's a little bit closer. So we're big believers that you don't want to just own the Mag 7. Yes, you should have them in your portfolio, and they likely should be the biggest part of your portfolio, but you want to have a lot in other companies as well. Small companies, mid-sized companies, international companies. That's really important because, again, like we talked about, the pendulum can always swing. But it's good to see the Mag 7 doing well. And they did great again in Q2, had another great quarter. This is about it shows our valuations. So PE ratio, price to earnings, it's basically the price that a company is trading compared to the earnings that it generates. And so if you have a high PE ratio, that means that the price is quite high compared to the earnings. If it's low, that means that it may be trading at a discount, right, compared to actually the earnings that the company are making. So you can see here the blue is the Mag 7, and it's trading at quite a bit higher than their earnings. Obviously, they have the earnings to back it up, but those prices are quite high. Whereas you have the orange line is the S&P 500, so including the Mag 7, and that blue line or teal is the S&P excluding the Mag 7. So you can see here it's uh, quite low, which could tell you there's some value there. So this is again a reminder of own more than just the Mag 7. Yes, you want them, but you want these others as well, that can help give you some real value. So generally speaking, stocks have done great. We can never predict where we're headed and what's going to happen, but history always is telling us that there could be more gains ahead, and a lot of it will be dependent on, again, the numbers. Do we continue to see companies have good earnings throughout the rest of this year? And then what we see with some of those other pieces like inflation and the Fed and trade policy. Let's talk about bonds. So bonds are your more conservative investments. These are there for more of a safety net. So if you're close to retirement or you're in retirement or you just have an account where you're going to need money soon, you likely and should have some bonds in there. So bonds have an inverse relationship with interest rates. So the price of the bond. So as interest rates go up, you can see existing bond prices go down. And on the other side, if interest rates come down, you see price of bonds go up. So interest rates, again, the Fed has been on pause, and the Fed is a big factor of where interest rates are, but it's also just growth and inflation expectations. That has an effect on where interest rates are going to be. And we've seen rates stay fairly level throughout the year. They've come down a bit, especially lately, but generally speaking, it's been fairly flat. And it's because we're in this tug of war between economic data and deficit spending. So as we've mentioned, some of the economic data has shown things to be slowing down a little bit. A lot of times that would cause interest rates to come down because as there's less growth, there's likely less inflation. That can cause interest rates to come down. But the deficit spending, like we mentioned, our debt, can cause interest rates to come up. We basically have to pay a higher rate to have people invest in the US because as there's more and more debt, that becomes just a little riskier. So we're in this tug of war where, okay, things are slowing down, but interest rates haven't come down much. So you haven't got that big bump in bonds as rates fall. So one thing to focus on is the income. If you own bonds, again, it's there for more conservative investments and good income. The bonds that we're using right now generally are paying in that 4 to 5% per year. So the income is really good, much better than it was 5 years ago where they were paying essentially nothing. So if you focus on that income, knowing that yes, the price of the bond may go up or down, but I'm going to get that good income. That's where you want to be. And this is the Fed funds rate. So this is what the Fed controls. You can just see it charted here where, it's higher in the early 2000s or mid 2000s. And then after the Great Recession, we cut rates to essentially zero and very low. And then they slowly started raising rates. And then in 2020, again, back down to zero. And then a rapid increase because we got that high inflation from increasing the money supply through the COVID pandemic, and rates, shot back up between 5 and 6%, and they have come down a little bit. It's likely that they will continue to come down, especially if the Fed is able to start cutting rates. So we could see rates start to come down. It's dependent on the Fed and some of the economic data that we'll get. So it could mean that some of the bonds are going to potentially get an increase in price if rates do continue to drop. I wanted to touch on the big beautiful bill that was passed. We did send out an email recently as well. It's a great email, a good recap of it. So there's going to be more in that if you're interested. If you didn't see that, we can also send that to you. But here's some of the highlights. So we had a permanent extension of the 2017 tax cuts. So they were set to go back up starting in 2026, and they've made that permanent. So we will not be seeing the increase in tax rates if they didn't pass this. So that's the biggest one. There's also some enhanced deductions, including this new 6,000 senior deduction. So if you're 65, you can get 6,000 for each. There are some rules based on income and whatnot, but that's a new deduction. They expanded the SALT deduction, so state and local tax deduction cap. So that increased. There was defense spending, there was border funding, there were some cuts to Medicaid and SNAP benefits. And there was this new Trump account for newborns where you can open an account and they'll fund it for up to, I believe, 1,000 for babies that are born in 2025 to 2028. And that can be like a retirement account for them. It's pretty amazing, actually. If you put 1,000 in and you just let it sit for 60 years, it has time to really do some good work. So again, if you have any questions on anything in the big beautiful bill, we can chat with you about it. A couple other considerations. I wanted to just touch on cryptocurrency as well as the dollar. So crypto, it's one of those things where I think there's two things to touch on here. One is it going to become the primary form of currency? That's a hard question. Not anytime soon, if at all. I'll say that. It's really, I mean, basically at all-time highs, Bitcoin and all that, and more and more hype around it. And the dollar is still overwhelmingly the primary currency, and it would take a long time to see a shift away from that. I think, when you look at history, currencies do change. We used to use shells at one point. So it's whatever we all put trust in, and knowing that, hey, if I accept that form of currency, I can then use it to go buy something else. And so it's, a currency is a tool to move wealth around. And so the currencies do change, but we're not on the cusp of, oh, crypto is now going to be what you use to buy and sell things. I think crypto is more like an asset class where you can use it and you can invest in it, kind of like you would in artificial intelligence or healthcare or gold, right? It's a different type of asset class. So should you have in your portfolio? That really depends. We don't generally recommend it. It's very volatile. It doesn't mean you shouldn't, but it's really specific for you. I guess my advice would be if you are looking at it, keep it small and be ready for a lot of volatility with it. But yeah, if you want to talk if it's right for you, we'd be glad to chat that through. And then as far as the dollar goes, I know there's been a lot of talk of is it losing its exceptionalism, its dominance around the world. There's other countries that are discussing, stopping using the dollar so much for their trade. The dollar is the primary currency, and that we do not see that changing anytime soon. Other countries have, for 50 years, been discussing getting rid of it. And there's a reason why the dollar is the reserve currency. I believe about half of all trade is done in the dollar. So yes, it may have come down a little bit recently, but it's still overwhelmingly the primary currency around the world. And there's really not any other good options right now. So another way to just hedge against a declining dollar is to own international stocks. So another reason why we believe it's good to have some of that in your portfolio as well. And I wanted to just show this graph here. It shows the S&P 500 back in 1970. If you invested 10,000, and in 2022 it would have been worth 2.2 million if you just let it ride through all this. But the main thing here is there's a lot of things that have happened. Just glance through this: wars, all kinds of things, changing of just how the world operates, and the market has continued higher. When you're invested in the market as a whole, you're essentially investing in the economy, right? Companies may come and go, but the economy continues on. And yes, we ebb and flow, and and certain companies take over, like Nvidia, become the most valuable company. And so again, if you're well diversified, you'll participate in all that. And we've seen markets hang in there through quite a lot. They're very resilient, and companies find ways to make money in all kinds of different environments. And then it's good to keep a long-term perspective. So this shows year by year from 1980. The blue bar is the calendar year return, and the orange is the intra-year decline. So again, most years are positive, but it's not a linear line. There's lots of volatility along the way, and you can see that here, where there's times where the market's falling, but like we showed earlier, it's usually short-lived. And if you stay the course and stick with your long-term strategy, you can participate in those gains, the blue bar gains. So just important to remember that there's going to be more volatility. There's going to be more downturns in the future. Just be prepared for that. We help our clients set their accounts up to handle the volatility so that we're never caught off guard by it. We plan for it. We're ready for it. And, you know, we know that that's going to happen. And fortunately, long-term markets reward the patient investor. So if you have any questions, go ahead and text 458-777-4458. Be glad to answer those. Of course, if you want to just chat with us personally, we can set up a meeting and do that. If you'd like a complimentary consultation, so if you are not a client yet and you just want to chat about how we might be able to help you, you can text market to that number and we'll get you on the calendar, get you scheduled with one of our advisors. LPL Financial, that's our broker dealer. So they actually hold our clients' accounts. So you'll see some, if you work with us, you'll see Financial Freedom, but you'll also see LPL Financial. They are the largest independent broker dealer in the country. So they actually don't have any of their own products or investments, which is a big reason why we like them, is we can go out and find what we believe is the best, and we don't need to be selling LPL funds or anything like that. So they kind of work behind the scenes. And there's our important disclosures for you. And thank you. Thank you so much. I hope you found some of it valuable today. Again, if you have questions on anything that I reviewed with you, I'd be glad to chat with you. Looks like we do have a question. Is now a good time to rebalance a portfolio? That's a great question. Yes, it can be. So it depends on what you're trying to accomplish with the rebalance, but let's say you're looking to maybe refill your conservative bucket, your conservative investments like your bonds. Now would be a great time to do that because you're selling stocks at a high point to refill bonds. That can be a great time to do it. You always buy low, sell high, right? It's the name of the game. And right now, everything is essentially high. Good question. Any other questions? Give it just a minute. Looks like there is one coming in. Should an investor increase exposure to international stocks? So it depends on what you currently have. So like I mentioned, it's important to have that in your portfolio. It also depends on where you're at in your retirement journey, how long you have. So as a general answer, yes, you want to have that there, but should you increase it? Well, that depends on how much you have currently and where you're at. So that's where we would need to look at your specific portfolio and see what you have and your goals and what you're trying to accomplish, and then we can make a recommendation there. Good, another good question. Okay, that looks like that's all we have. Thanks again, everyone, and have a great rest of your day. Bye-bye. Oh, wait, we might have one more. Gotta make sure we answer all these. What about Social Security income tax? Yeah. So that's one where, yeah, I know there's been some thought, oh, they took away taxes on Social Security. They didn't exactly do that, but with some of these deductions, it can help offset some of the Social Security tax. So yes, it can still be taxable, but it likely will be less taxable for a lot of people. So that's where we're at with Social Security. So like that 6,000 deduction, extra deduction, that can help offset some of that income and help reduce any potential tax on your Social Security. But yes, it's still potentially taxable. Okay, I think that's it now. All right. Take care. Bye-bye.